Good morning, everyone. I am CA Shruti Gupta, moderator for the 39th Valuation Manthan session, Valuation of Distressed Assets, organized by the Valuation Standard Board of ICI. We are delighted to welcome you all to an empowering journey through valuation expertise, and also I wish you all a very happy new year. So, as we start this session, I would just want to make a small announcement. Today, we'll be taking up questions in parts. So, the session is scheduled in a way wherein you can ask question for each part. So, if you have any question, you can share it with us through the question domain that is available to you on your web screen. So let's start without any delay. Let me start with the session, and I would like to welcome the speaker of the day, Vishal Gupta ji. He's a renowned valuation expert and also a doctorate student with the Swiss School of Business Management. Vishal Gupta ji is currently associated as a president with the Intelligent Group. He is a competent professional with experience of over 8 years in valuation and stressed assets, resolution, uh, He's a competent professional with experience of more than 8 years in valuation and stress assets resolutions and has completed over 200 valuation assignments under various statutes, including Companies Act 2013, IBC 2016, and Income Tax Act. His clientele include Target Corp, Visa Steel, Siaram Silk Milk, Sham Steel Industries, Ispat Damodar, HNG Industries, and many more. He is also a guest lecturer and a regular writer for the Institute of Cost Accountants of India. A lot of his publications have been published in various journals since past few years. Thank you so much, Vishalji, for gracing us with your presence. We are all eager to learn from you. Over to you, sir.
Thank you, Shruti, for that stellar introduction. Uh, before just before making any further delay, let us just get into the session. So, before we get into the specifics, let us clarify on what this session is about and is not about. So, this is about the valuation of distressed assets. Now, as you're aware, typically for registered valuers in India, the asset classes are divided into three portions: land building, plant and machinery, and securities and financial assets. Typically, most of the chartered accountants here would be registered valuers for securities and financial assets. So that is largely what we will be focusing on. We will derive on some principles from the land building and plant and machinery asset classes, but this will be mostly about the valuation of securities and financial assets. What that would mean is it would be mostly valuing the shares of companies and the debt that lenders will hold, the market value of debt, on how much that debt could be sold on. And then there can be various permutation combinations in it in terms of whether that debt is convertible or callable. And equity would be typically a pure play equity or a preference share. But that will be the realm we will be dealing in. We will not go deep into tangible asset valuations in distress. So, proceeding further, what would you say what would be the typical features of a distressed assets, if you would care to share some thoughts? All right. So typically, a distressed company would be a company which is either in declining mode, which is not able to earn enough to manage its operating costs. That would be typically having high fixed costs, or the gross margins are negative, or the debt is so high that the profits and EBITDA is not able to service the interest payments. So there's no formal definition in the legal context of what a distressed company looks like. So rather than a definition, it is more of a spectrum ranging from a company which is, let's say, having difficulty in making its interest payments, to a company that has officially entered liquidation and is going to be wound up. a typical feature of such companies would be that debt would be a high percentage of the value of the firm. So let's say you value a company using the firm valuation, not the equity valuation. So the firm valuation, let's say if it's 100 rupees, debt would be typically over 80, 90, 95, and that might even be more than the value of the firm, rendering equity to be typically negative, which is the case in a lot of distressed firms. That the value of equity, the book value goes negative, and the company is not really worth anything. But yet the shareholders do hold the equity. It is tradable, so there might be some value in it that we will try to calculate. Uh, Another thing to note is that the equity investors have a say in choosing the management of the firm. However, they have very limited liability. Typically in India, lenders do take a personal guarantee from the promoters who are running the business. But apart from that, if you look at the company per se, a distressed company, the equity, if the company runs into the ground, if it has no value, then the equity holders have a very limited liability. They cannot be asked to supplement the negative equity of the firm. The lowest the value of the equity can go is 0 and not beyond that. So that typically comes up in our calculations time and again, that the value of equity cannot go beyond lower than 0. Another thing to note is, in most of our valuation considerations, there is an inherent assumption of a going concern. However, for a distressed company, the going concern assumption does not hold. So we need to tweak our calculations, and we have typically been in the mindset that whenever we're doing a valuation, we're doing the valuation for a going concern. This assumption will no longer hold when we're looking at distressed companies. Further, your cash flows will be affected. Distressed companies are looked at differently and treated differently by society in general. Their stakeholders being employees, customers, suppliers, lenders, regulators. So if a company is going through distress, the regulators will have tighter policies, the suppliers will have a tighter credit policy, the customers will be wary of the after sale service, employees will be looking for different jobs. So this a company which is already going through distress, this will add on to the woes of those companies, and all these factors will need to be incorporated in a typical valuation to be so that it can be adjusted for distress. So we need to always keep in mind, if we remember our first principles by which we value any firm, which is we have to make a note of what are our biases and preconceptions, because there are always some. We never approach any valuation with a clean slate, even though we say that we are unbiased and we have no conflicts. And typically, we do not have any conflicts, but we always go with a mental framework that this is near about what the value should be. And if our calculations come grossly away from it, we try to tweak our calculations rather than tweak our expectations. That So we need to be always be aware that all these biases need to be adjusted for a company which is in distress, and we cannot treat it as a normal company. So there are three ways in which we're going to be looking at the distressed asset valuation calculations. Firstly, we will go into a typical DCF model on how we value any company in a regular DCF setup. And we'll try to tweak those DCF models for a distressed asset case. Next, we'll go into relative valuations and try to see that how those relative valuation calculations can be tweaked for a distressed asset case. Finally, we will try to look at distressed companies as an option and try to incorporate option valuations as for the calculation of distressed equity. Finally, we will look into how distressed assets affect the liquidity of a company and try to charge some discount on it, because a distressed company will be more difficult to sell than a normal company. So there will be some discount, which we will call the cost of liquidity. Is it okay till here? Can we move ahead?
Yes, sir, we can move ahead.
All right. So typically in a DCF model, there are 4 questions that guide the entire DCF process. What are the cash flows of the company? How risky are the cash flows, or how uncertain are the cash flows? What is the value added by the growth assets that is incorporated in the capex and working capital calculations? And when will the firm become a mature firm? So let us take these all one by one. What are the cash flows from the existing assets? So what are the assets that are already in place in the firm? And what are the cash flows that can be expected from these assets? And typically we would see that in under normal operations, the cash flows would be stable or would be growing at a nominal rate. Or if there are any growth assets, then the cash flows would be incorporating the increased cash flows from those growth assets. That is how your normal DCF works. However, in the case of a distressed asset, we will see that the revenues are flat or maybe even declining. The margins are either falling or are negative. And typically you would see in a normal DCF, the margins are positive or strong, or unless it's a early stage growth stage company, the margins would be positive. Even if it's a growth stage company, the margins would be becoming positive during your projection period. That is what we see in valuations when we do DCF typically. However, in the case of distressed assets, that need not be the case. The margins can be negative and continue to be negative, and we might not see a recovery, or we might not see that the gross margins or the profit margins of the company are becoming positive or becoming stable. That may not be the case. One typical feature would be that earnings are often less than the cost of capital. So the if your firm is if the firm is earning anything, the reinvestment would be negative, that you are scraping off assets, you are selling off assets, and the earnings are, and the free cash flow to the firm is more than what you had earned because you're shaving off assets. Then what is the value added by growth assets? Now, this is the company that you do not want to grow. Rather, you want to shrink it. Because if you keep on growing a company at a negative margin, where the return on assets is less than the cost of capital of those assets, then you might be growing in terms of revenue, but that growth is going to destroy value. Because the more you grow, the more you're going to lose money on those assets. And you don't want to grow in such a scenario. Rather, you want to shrink the firm down to a manageable and sizable company. You want to reduce assets. You want to use the proceeds from those assets to pay off debt. And that is what your DCF should project, that you're slowly becoming a smaller firm. Your margins are becoming stable. Coming to risk, which is typically seen in our discount rates, which is calculated by the CAPM equation or the cost of debt. Now, this will keep on changing through the projection period. Why will it keep on changing? Because your debt equity ratio will keep on changing. Because as you are divesting more and more assets, the debt, and you're paying off debt, the debt equity ratio will change in each period of the projection period. And hence the discount rates will need to be adjusted for that. Finally, when will the firm become a mature firm? In the past. This is not a firm which will become a mature firm. This is a firm which has entered decline. It has already gone through the mature phase. So the path to stability, once more, will be when the firm shrinks down to a much smaller entity. The stability will arise at a later stage, maybe with a lower cash flow but stable margins, all to protect the company from dying. And then we also have to consider the possibility that this might not remain to be a growing concern, that there might be no value in perpetuity. The problem with DCF is that there is a huge value that comes in terms of terminal value that comes at the end of after the projection period. We have the terminal value. The terminal value assumes that the firm will continue to exist in perpetuity. However, a distressed firm may not live to see that time, that it will stay on till perpetuity. That needs to be incorporated somehow in our calculations, which a typical DCF model does not incorporate. Coming to any questions still here? We'll come to the next slide on seeing how do we make those adjustments to the DCF model. So we'll go here. Now we'll go once more that what are the problems with the typical DCF model. DCF has largely been designed for large firms which have stable earnings. DCF is dependent on the predictability of the cash flows and predictability of the discount rates. If any of those things are unpredictable for a company, it becomes very difficult to have an income approach DCF model for FCFE or FCFF in any firm. Secondly, but since we have to value all kinds of firms, DCF might not be applicable for distressed companies. Secondly, we must also remember that even large and stable companies do often go through their own times of distress. So DCF models need to be tweaked from their current form to incorporate distress in those times, even for stable companies. Another thing that DCF assumes that the access to capital is unconstrained. What do we mean by that? It means that in DCF, we typically assume that we will take a debt of this size and the cost of the debt is given with the kind of debt, depending on the debt equity ratio of the company, the size of the company, the credit rating of the company. However, there might not be institutions that are willing to give off debt to a company which is already in distress. So even though the numbers might make sense on an Excel sheet, when you go out into the capital markets to raise equity or raise debt, there might not be a market big enough to raise that kind of capital. And hence your DCF might fail there. So that will need to be tweaked. Third point is, we often try to raise the discount rates, raise the cost of capital, cost of equity, cost of debt to incorporate distress. Now, that is not the only place where distress appears. Distress will reduce the cash flows, not only increase the discount rates. And we have a choice to make. We can either incorporate the stress in the cash flows or in the discount rates, but not both, because that will be a double counting of stress. Typically, what you would do is you would add a very large premium to the discount rates to factor in for the distress. But that might not always be the correct way to factor in the stress. You might want to take in the stress through the cash flows. Why that is a better means is because there might be a time when the cash flows reduce to zero. There might be a chance that the company does not stay alive to go through to be a going concern. That will never be incorporated in any discount rate, no matter how high you take it. So discount rates are not the only way to incorporate stress. And that is what we typically end up doing, even for startups and for distressed companies. DCF works very similar to in both cases because the amount of uncertainty about cash flows and discount rates is very similar. It just happens that startups do not have debt and distressed companies typically have some sort of debt. Another thing is that the discount rates, which are primarily calculated through the CAPM model and primarily take their input as beta. Beta only takes in a systematic risk, whereas distress can come through many unsystematic macro and micro risks. What we mean by that is a company might be going through some sort of a problem that is appearing in its own industry, or a company might be very sensitive to political movements in its economy. Those factors will not be incorporated in any kind of a beta model. So that will have to be separately calculated, and that will not be incorporated in any kind of a discount rate. Again, we've spoken about this. Cash flows might not be there till perpetuity, and that needs to be incorporated in the DCF model. Another problem in that approach is it is very difficult to estimate in which year will the cash flows stop. The cash flows may stop in the first year itself, or they may stop in the 10th year itself. The probability of the cash flow stopping in any particular year needs to be incorporated in the DCF model. Now, an argument that is given in favor of DCF models is, even if we are making any kind of divestments, the present value of the divested assets will be equal to the future cash flows received from those assets. Now, there's a problem over here. We assume that the cash flows from any assets keep on growing. Whereas if we sell off any particular asset in any particular year, the cash flows from that asset in that year will stop coming in, and obviously they will not grow. Secondly, it is impossible to predict which year will the divestment happen in. If we are making a projection period of 10 years, we cannot predict that which year these divestments will happen and the cash flows from those assets will stop coming in. And once that happens, all the cash flows in the year subsequent to that divestment will stop from that asset. So these will be the problems we will face while tweaking our DCF model, and these are the answers our DCF model needs to give us. The only places where DCF can be reliably put in is where let's say, the debt is guaranteed. The debt is guaranteed by a sovereign guarantee, or the entity is such a systematically important entity that it will not face any stress because of distress. We will have to assume that there is easy access to capital markets, which is not there in India. As soon as a company goes into distress, nobody's ready to fund it. So we cannot implicitly assume that at any high enough discount rate, the company will be able to raise capital. That simply does not remain true. The cash flows and the discount rate will have to incorporate the likelihood of distress, but not both of them. Either of them, and in proportion. If we try to incorporate distress in the probability of distress in both cash flows and discount rates, we will be double counting for distress. That is something we do not wish to do. And we will have to assume that the sale proceeds from divestment will be equal to the present value of the future cash flows from that particular asset. So what are the adjustments that we need to make in our DCF models? Firstly, our beta will change every period because of the changing debt to equity ratio and the consequent changes in the credit ratings. So we cannot use a regression beta here. We cannot use a market multiple levered beta over here. We will have to have an unlevered beta, that is beta without any debt. And we will have to keep on adjusting it period over period so that it keeps on changing with the changing debt ratio of the company. And there have to be some additional risk factors in the DCF model that incorporate distress. So these will be the changes that we will have to do. For our projection period, there would be a negative growth rate. What do we mean by negative growth rate? So you can see this is the illustration we did for a distressed company. In the projection period, towards the beginning, there is a negative revenue growth. And that is the firm is having a lower scale of operations. And during the projection period, it reaches a bottom point and then it starts growing again. What do we want to typically do in such a company? We want to sell off all the bad assets that are not generating their cost of capital. So if you look at the reinvestment rate, which is right over here, the reinvestment rate, it's negative. What do we mean by a negative reinvestment rate? That on a net basis, we are not infusing capex into the company. Rather, we are taking assets out of the company and selling them off into the market. And you see that these assets are not having a very big impact on the revenue. So they were not generating those revenues anyway. And it was good enough that they were sold off so that revenue generating assets could be retained and these assets could be used to starve off the debt of the company. The feature is the negative reinvestment rate, that is net capex, will be negative. What we are trying to build is a smaller company which has healthier margins than before. So while you are making these divestments and while the revenue growth is negative, the margins should be improving. An improvement in margins is a sign that the company is going towards a healthy stage. But that's not what typically happens in a declining company. In a declining company, the management tries to revive the company back to its high growth, high revenue glory days. So what do? They take on new projects, they try to expand the company, they try to increase revenue, they try to make the company as big as before or even bigger than before so that they become star performers. That is the worst thing you can do to the company. For a distressed company, you do not want to increase revenues, as we discussed. In an increase in revenue would mean you're taking up more projects that do not earn their cost of capital. So you're infusing money in things at a cost that does not bring you the returns, at least equal to the cost. So this will be a management in denial. And what the best thing you can do with such a management is sell off the equity at whatever rate you get. Because this will render the equity negative if allowed to go on. You're not looking to grow the company and become a star performer. You're looking to shrink the company and allow it to live to fight another day just to survive. Growth in this scenario becomes a destruction in value. A negative growth rate will allow the company to live on. Now, if we only do a DCF in this case and let it be, then we will end up in a the probability that the company will not remain a going concern. To be able to incorporate that, we will have to tweak some calculations. There are two ways of doing that. So let us just run through this valuation and we'll talk about the two ways in which we can adjust for the going concern probability. So we have the revenues, we have the EBIT margin, we have the tax rate, we have the reinvestment. So this is a special feature of distressed companies, that the free cash flow is actually higher than the after tax operating profits. Typically, what happens is once you have the after tax operating profits, you reduce the reinvestment, you have some capex, you have some working capital infusion, you have some growth, and then your FCFF is lower than the operating margins. However, for a distressed companies, you're looking to divest, not invest, and hence the FCFF will be higher than the operating margins. Then you calculate your cost of capital, you calculate the present value of FCFF that you typically do in every valuation. I'm not going into this deeply as of now. I'm assuming that a normal valuation is understood by everyone here. So you have the terminal value, you have the present value of the terminal value, you have the present value, you have the addition of both the present values of the projection period and the terminal value, and you take a probability of failure. How do we calculate this probability of failure? That we'll get into. And you say that if the company fails, the value of the firm, not the equity, the firm, the value of the firm will be, let's say, half the book value. Now, how do we get it? Whether it will be half or what will be the value of the firm, that we'll again get into later. So we have left two questions on how do we calculate this probability of failure and what will be the value of the firm in the case of failure. And we take a weighted average that 80% of the times when the company does not fail, then the value of the company will be 3,900. Whereas 20% times when the company does fail, the value of the firm will be 2,421. And hence we take a weighted average and say that the value of the firm will be 3,605. So there's a problem in this calculation. 20% is an annualized rate of the probability of failure, and the firm might fail in any of the 10 years in which we are saying that our projection period exists. So if the annual probability of failure is 20%, then the probability of survival is 80%. In any particular year, there's an 80% chance that the company will survive. The cumulative probability of the survival of the firm for 10 years is 80% to the power 10, which comes to 11%. So there's an 11% chance that the company will actually survive and our DCF model will run right for 10 years. There's an 89% chance that the company will fail in any of those 10 years. And on that scenario, when there's a total failure of the company and the company does not operate anymore, when the company does not operate anymore, we're saying that we've shut off the company, the debt is too high to pay off the assets. In typical cases, the shareholders will not get anything. And the value of operating assets will be 3,900 multiplied by 11%. That will be 419. Any questions on this calculation or anything till now?
So yes, we have a couple of questions. The first question is, how do you address the uncertainty associated with projecting the sale of asset in distress situation using DCF?
So here the assumption is that the present value of the sale of any asset in DCF is equal to the present value of the cash flow generated from that asset. That's the only way we can tackle this question. That's a very reasonable question that we do not know that when an asset will be sold off and that we will not be able to incorporate in a DCF model. The mathematics will become too tedious. We will have to have an assumption, and this must be stated, that the present value of the cash flows generated by the asset will be equal to the present value of the sale of the asset.
Thank you so much. So there's another question. Considering the assumption of continuous access to capital markets in DCF, how would you adjust the discount rate for a distressed firm with constrained access to capital?
So the best way to do that would be to not assume any capital infusion apart from divestments. We cannot go ahead and say that the company is in distress, yet it will go ahead and take debt at a very high rate. That will not be possible. And if you're not able to do that, then the second way would be we go in and show that there's a debt raising or there's an equity raise by the company, but we take the appropriate discount rate. So, for example, we take the discount rate as prescribed by a rating agency for a default class. That is a D class debt, and we take that discount rate. And when we take equity, we apply a very high alpha, we apply a very high beta, and we try to calculate the highest possible cost of equity and do a fundraising at that rate. But even then, it should not be obscene, that we should not be saying that, okay, my firm value is 100, but my capital infusion will be 10,000. There has to be a reasonable assumption. What that quantification of reasonable, according to me, should be zero. But if your DCF model does not work at zero, then maybe raise capital equal to the value of the firm, but not more than that. That would be reasonable.
Thank you so much. We can move forward with the session.
All right. So in this slide, we had left off two questions. One, what is the way to calculate the probability of failure? And two, what will be the value of the firm if the firm fails? So we'll come to the first question. What will be the probability of failure? Now, there are several ways to do that. The easiest way probably to do that is to check the credit rating of the company. All the credit rating agencies have an annual disclosure in which they give that against every rating category, what is the probability of failure of the company. So as we were saying that for a AAA rated company, the probability of failure in 1, 2, and 3 years is 0%. For a C category firm, the probability of failure in 1 year is 15%, for 2 years is 25%, and for a 3-year period is 31%. Similarly, you will get different discount rates for different probability of failures for different rating classes. You can take the probability of failure straight away from here. There are other ways of doing that. There is a probit regression, which means that you take a 5-year or a 3-year or a 10-year horizon, and you take similar firms in such a period and see what percentage of them actually went bankrupt or went NPA. And that will be the probability of distress. Another way to do it is if the company has issued any bonds in the market and they're listed, so you use those bond ratings to estimate the probability of distress. An assumption over here is that the rating agencies are good at estimating default probabilities. How true that is or isn't, we will not get into that today. Personally, I will like to make my own assessment rather than just going with a rating agency probability. There's also an assumption that the rating standards do not shift over time, which of course they do. If you just compare rating reports for any rating agency over 2 periods, you'll realize that how much they shift. on a year-on-year basis, there is not, the ratings are not very consistent in terms of their standards. A rating of a particular company may be very stable, but what that rating means is not stable. Again, distress is a spectrum. It's not a one-off event of failure. There's no even definition of what failure means. It can be the inability or difficulty in paying off interest. It can be a declaration of NPA. It can be an insolvency case against it. It can be the winding up of the company. So there's no way of knowing the probability of distress will be equal to the probability of default. And that does not mean that the company will not remain as a going concern. So the difficulty with using rating agencies will be that if there is a market value of debt, if the debt is being sold in the market, if there are coupons, then you calculate the probability of distress using an equation, which can be very easily solved with using a solver function in Excel. This being the equation. So this is how we typically calculate the bond prices of any bond issued by any corporate. So because bond prices are focused on basically one thing, that whether the bond will get paid or not. So all you have to do is adjust it for the probability that it will not be paid, and that will become the probability of distress. Now, this does not consider what if the bond is paid, but not partially, not in full. This equation will fail to incorporate that. This equation also fails when the bond price is not available. So when there is no market value of the debt, this cannot be used. Cannot be used for convertible bonds. And the probability of default for different, one problem is that the bond is not available. Another problem is when multiple bonds are available. So which one do you take? What we do is we take a weighted average, that what is the face value of each bond. So we will take the entire price of all the bonds, all the coupons, and all the face values, and try to put a solver function on that to calculate the probability of distress. Another way is to calculate the Altman Z-score, not very popular in India, but widely used elsewhere. This is a research paper where they took many different factors on what would be the causes of distress, and they assigned certain weights to that. And they gave us that this will be the probability of default of any company, which may be used in India as well, and is widely used in banks across the world. So this will answer that what will be the probability of distress. Second question that we left off was, what will be the value of the firm in case the firm fails? So if the debt is too high, then there is no value to the equity, but there is value to the firm. So what will be the cash flows and the value of the firm? You asked the question that how do we calculate when the assets will be sold off? So we cannot do that. We can make a assumption that they will be sold off in year 3 or year 4 or year 5. And to adjust for that, let's say it does not get sold in the year that you imagine, you take no divestments, but you take a smaller percentage of the cash flows you're getting from those assets. For example, let's say you have a factory, and that factory is generating revenues and you're incurring costs, and there's a gross margin that you're incorporating from the factory, and you're going to be selling off the factory. And you do not know in which year you will be selling it off. So you take a percentage of those cash flows during your entire projection period, let's say 80% or 70%, to incorporate that at some point these cash flows will stop. Next thing what you do is, you take the cash flows, but only from the existing assets. You do not take the cash flows from any growth assets, any new investments, any new capex, and only keep the cash flow stable under the assumption that whoever is going to be buying the company will not buy the growth, will not buy any future investments, will only take the company for its existing assets. The third and simplest way to do it is you take a percentage of the book value of the assets. This thing is typically done in plant and machinery valuations. Land and building is done in a separate way, can be incorporated for securities and financial assets. When you have no other way of telling the book value of assets, let's say your company has invested into many securities of unlisted, unquoted shares. So typically what we do is take a percentage of the book value of the assets. So that is all about the tweaking of the DCF model. Any questions still here?
Can we take questions in like next 5-10 minutes?
All right. So next let's take the questions for relative valuation together with that then. So the tweaking for relative valuation will be very similar to the tweakings in DCF, but let us talk about the challenges here as well first. Typically, the earnings and book value for a distressed company might be negative. So there's no point of using a PE or a PB multiple. In fact, such a multiple may not even be computable. So what an analyst will typically do is they will try to keep moving up the income statement to find a positive number. That is why they will take a revenue multiple or an EBITDA multiple to come up with some meaningful multiple to put into their relative multiple calculation. Now, like with normal relative valuations, this works best if there are multiple firms of similar kind in the same sector. But it's going to be very difficult to find multiple firms that are all in stress in a particular sector, unless that entire sector is going through stress, which does not happen very often. So the next good way to do it would be to compare for distressed firms across sectors, because even though these are very different companies, but since they're all going through stress, their financials might look similar and their management might be of a similar mindset. So it might be okay to compare them with distressed firms across different industries. And multiples can be adjusted for bond ratings. This is another thing that the rating agencies do is they will publish a list of what the rating is. Against that, what is the average value to book ratio of the companies? So you can take that, and this is an analysis we did for one of our companies, and we came up with such a number. So let's say you are doing a valuation in which the rating of your company is single B, whereas the multiples that you are finding in the industry are all rated triple B. So you need to make that adjustment in your relative valuation calculation, that if you're doing a value to book ratio, that is a EV by book value ratio, and the multiples that you're using, the comparables that you're using are triple B, and so instead of using 1.61, you reduce it by 1.61. That is, you divide the multiple by 1.61 and multiply it by 1.06, so that you will find a better measure of relative valuation. That is a better way of, sometimes what we do is we would simply use a subjective bias, that we understand that the target company will be trading at a lower multiple than its industry peers. Now that lower multiple will be a subjective number up to our discretion. This is a problematic thing. It invariably leads to bias, and there are no ways on to justify or not justify that. better to use a justification model using a credit rating. The probability approach works here as well, as we did in the DCF model, that you forget that the company is in stress. You do a normal relative normal calculation of relative valuation, and then you multiply it with a weighted average of probability. So let's say in a normal relative value calculation, you arrive at a figure of 100 of distress is 30%. So 100 will be multiplied by 70 and 0 will be multiplied by 30. So you come up with a value of 70, which is adjusted for the probability of distress in a relative value calculation. The problem here will be, again, the shifting debt load. That is, the debt equity ratio will keep on changing. So your relative valuation will need to be adjusted for that as well. And in such companies, the debt shifts very fast. It might not even wait for a year to shift, and the reading of the annual reports might not be relevant. You'll have to keep on looking into the company management's interviews, or if you know the management, that is better, or at least news articles to see where the restructuring and settlement of debt has reached. And depending on that, your debt equity ratio will keep on changing. Depending on that, the valuation will keep on changing. Now, that debt itself might have different features, like it might be callable, guaranteed, convertible, and all that will need to be incorporated. If you're able to get the market value of debt, if you get to know that the debt is being sold by the lender, then that is a better proxy for the value rather than simply taking the face value of the debt. The lender might be looking to sell off the debt at a discount. So every few months, you'll see all these banks publishing the sale of debt to ARCs or to typically their ARCs or NBFCs, that we are willing to sell off the book value of 100 rupee debt for 70 rupees to any buyer. That value is the market value of debt and is a better measure than the book value of debt for any adjustment in the debt equity ratio. So that again is all about relative valuation in distressed assets. We can take questions if you have. Otherwise, we will move on into the options valuation.
Yes, so we have a couple of questions. So increase in EBIT margin over the years, what is the basis for that?
So I believe you're coming here.
Yes, I have.
Any
so there are a lot of questions from this slide. I'm so sorry.
That's okay. Any distressed company will be going through since it's distressed, it's going through low EBIT margins. Because why did it fall into distress? Because it was not able to generate good margins to pay off either operating costs or to pay off debt. So in this particular case, what we saw was that the EBIT margin was very low. In fact, it was much lower than its industry peers. As we are shaving off the bad assets, the assets that are not generating enough revenue or enough return and are not meeting their cost of capital, they are the assets that are generating a smaller EBIT margin. So even though the EBIT might reduce in value, although in this case it did not, but let's say the revenue fall was higher and the EBIT would have reduced, the EBIT margin of a company going from distress to health will typically increase. And that is what should be incorporated in the DCF if you think that the company will remain a going concern.
Thank you so much. Moving forward to the next question. How is the figure of rupees 2421 arrived at? Proceeds if the firm fails.
Yeah, this is what I said, that this is how it is arrived at. In this case, we took it as the 50% of book value. but there are other things you might be able to do. You can take a market value if that is available to you. In this case, the assets were assets consisted of, what do you say, unquoted equity. So the only way we could go for was take a percentage of the book value. We took 50% of the book value. If you don't want to do that, you can go into a valuation of those assets themselves and try to calculate that what will be the fair value of those assets. Or you can take a percentage. We took 50% of the book value.
From where can we get discount rate for different class of companies?
Discount rate for different class of companies, you typically start with a FCFF model, where you calculate weighted average cost of capital, that is cost of equity and cost of debt. Cost of debt, the best way to do it is the rating agencies. You get the debt rated, and with that, you take a discount rate for the period of the projection period. So if it's a 10-year projection period, you take the 10-year discount rate. If it's a 3-year or a 1-year projection period, you take the appropriate discount rate. Cost of equity, there's no real good way of doing it. You take a very high a beta as you can find, and then you add an alpha as per your judgment. There's no way I know to have an alpha for distress, but that would be a very high cost of equity, as high as you can find. Or one thing you can do is that since the value is largely going to be guided by debt, equity is going to be a very small portion, you take the cost of equity equal to the cost of debt.
Okay, thank you. We can move forward with the session.
All right. So till now we have gone through what is distress, how do we tweak DCF for distressed assets, and how do we tweak relative valuation for distressed assets. Now there's a way of valuing the equity. Till now we have always focused on the value of the firm, and we have said that this is the value of the firm. You take out the debt from it, and whatever remains will be the value of equity. However, an interesting scenario arises when you try to value the equity of the company directly using modeling it like an option. And there's a way to do this, but let's see how and why we can do it. So what is a distressed company? A distressed company is a company that is losing money. It's expected to keep losing money, and it has a lot of debt. Why would you invest in such a company? You would invest in such a company for the same reasons you would invest in a deeply out of money option, that it is out of money right now, but there is a possibility that you can acquire this company at a very cheap rate because it's in a severe distress right now. And then if it comes out of distress, which is a very low probability event, but if it comes out of distress, there's a very high chance of return. Such a company will be very volatile. So this is starting to look like a out of money option. Another thing is, what do you mean by acquisition of equity in a company? You become the owner of a company. You have some say in decision making by choosing the management. You have a limited liability. The maximum you can lose is your investment and not a penny more than that. And you always have a right to liquidate or sell off your investment. This starts to look like a call option, where the value of the firm is very low and you invest in it, so you can lose your investment. And you lose your investment till the value of the firm becomes equal to the value of debt. As soon as the value of the firm starts going beyond the value of debt, you pay off the debt and your returns can be very high. This is the exact same graph that is made for a call option. In fact, the value of assets minus the value of debt, which is the value of equity, is equal to the value of equity at least up to 0. It cannot go less than 0, And this is how a call option can be modeled. So this is something we did, that let's say you have a company, asset value 100 rupees, and it's trading in the market with a standard deviation of 40%. Now, let's say if it does not trade in the market, then what do you do? We'll come to that in a bit. How do you take all these inputs? The face value of the debt is 80 rupees. Now, we are modeling the debt in a way that it becomes a zero coupon bond, so that it's easier to model. And the time to maturity is 10 years, and the risk-free rate is 10%. 10% is too high, but it's for a model. A more reasonable number would be 4%. And we apply the Black-Scholes model on it. The Black-Scholes model, if you are aware, is a mathematically complicated model. We will not go into the intricacies of how that mathematics arises. You can check the calculations if you want. And this is freely available. You just have to Google Black-Scholes calculations and you'll get an Excel sheet that is pre-made for you. So what we get is that the call value of such an option, where the current price is 100 and the strike price is 80. So as long as on the date of exercise of the option, the current price is higher than the strike price, you make money. If it is lower than the strike price, you do not make money. But in any case, the option itself will never go to zero. It will have some value. So the call value in such a scenario would be 63. But here's the question. If the value of equity in this case is 63, where is this remaining value coming from? From 100. That is the value of debt. For this value of debt, you would ask that how come we are valuing a 80 rupee debt at 36 rupees? That is a 80 rupee payout of the debt at the end of 10 years for a zero coupon. There is some price appreciation. So if you were to pay someone for the acquisition of this debt, which will be paid back to you after 10 years for 80 rupees, how much would you be paying for it today? This is the answer. You would be paying 36.86 today. And the cost of debt, which is calculated, is 8%. Now, here's the interesting part of it. No matter how much we kept on reducing the asset value for the same assumptions of standard deviation and risk-free rate, we get the same, the value of equity keeps on reducing, but it never really goes to zero. There will be some value that will be discovered for each value of asset, no matter how low it gets. It just keeps on becoming a more and more out of money option, but it never goes to zero. And in this way, we can model a distressed company for an out of money option, as an out of money option, and model it as equity, and model it as option. Now, for this calculation to be valid, you need four things. What is the asset value? What is the standard deviation? How do we convert all the debt of the company into a zero coupon bond? And what will be the time to maturity? So we'll take these questions one by one. Value of assets can be calculated by the first two methods we used in DCF or relative valuation. Remember, we tried to take the firm value out of it, not the equity value. The firm value will be equal to the value of the assets. So we can do a DCF model, or we can do a relative valuation, or we can, if available, we can simply use a market value of equity plus the debt, which will be equal to the value of the assets. Remember, try to use market values and not book values. What will be the variance in the firm value? Now, you would want to use the variance in the stock prices and the bond prices of that particular company. but that particular company might not be having the right variance in the prices because of its position as a distressed company. It might be going through too much or too little variation. An industry average variation of such a company will be more appropriate to use for this purpose. What will be the value of the debt? So we take the face value of all the debt outstanding and all the coupons that will be payable till the end of the maximum tenure of all the debts and call it the value of the debt. That will be the entire amount payable at this point in time that will have to be paid, and the asset value will have to be more than that for you to make money as a call option. And what will be the maturity? The maturity will be the tenor, the weighted average tenor of all the debts. So using these four assumptions, you plug it into the Black-Scholes model over here, and you get a value for call, which is effectively the value of the equity of the company. And then whatever remains after the equity from the firm is the value of the debt. Depending on that value of debt, you can calculate the appropriate discount rate. So you see that even though as we keep on reducing the asset value over here, and the equity value does not go to zero, the cost of debt keeps on increasing, and debt starts taking a bigger share in the total value of the company. So let's say when the asset values are 100, the debt is 36% of the company. Whereas as the asset value keeps on reducing, the risk of the debt holders keeps on increasing. Interestingly, the risk of the equity holders keeps on decreasing because the largest portion of this company is now being funded by the debt holders, and it keeps on becoming a riskier and riskier investment. But a larger portion of that risk is being undertaken by the lenders and not the equity holders. So this is about valuation of distressed equity as a call option. There would be some questions here. I hope there are. This is a mathematically challenging topic.
Yes, there are questions. And so, where do you get these rating agencies data shown in the presentation?
Rating agency data, like this.
Yeah, probably yes.
You Google for them.
In case a company goes in for restructuring,
Just a moment. Let's see if we Google for them. Do we actually get anything? So yeah, this is freely available. You get a report like this, and you get the default. No, these are the stability readings, but you get a default probability for you get a default probability in reports published by these rating agencies. So you can take it from there.
in case a company goes in for restructuring, how is this factored in the valuation?
You have to be vigilant about that. We have been saying this, that the debt equity ratio will keep on changing frequently for a distressed company. Your DCF will not be able to incorporate that. So if the company is going to be going through a restructuring during a projection period, you must know what kind of restructuring it is to be able to factor it into the DCF. If you do not know the terms of restructuring, you're not going to be able to model it into DCF. DCF can only incorporate cash flows along with some uncertainty that they may not happen. It cannot model in very unsystematic events that cannot be modeled for.
The next question is, how is the terminal value 2877 arrived? Is this after applying factor of probability of failure?
No. I guess you're talking about this now. This is not taken after applying any probability of failure. This is a simple terminal value calculation. We take the cash flow of the last period, multiply it by growth, divided by cost of capital minus growth, and take the present value of that. All the probability of failure is incorporated afterwards, and then we take a weighted average of the value in a normal circumstance and the value in case of failure.
So the next question is that you were just talking about that we can take cost of equity as cost of debt. So how can that be done?
So let's say you have a very distressed company and you've gone into the market. You have a very distressed company and you've gone into the market to raise capital. Now, no one's going to be funding it for equity or debt, but we have a ready discount rate for debt, which is published by rating agencies, which will be a very high discount, which will be a very high cost of capital, typically in the order of 35 to 40% for an NPA company. This is as per CRISIL ratings. So no equity holder is going to be coming in and say that I will take a equity risk, a loss risk in the company, and I will be paid less than the debt holders. They will want to be paid more than the debt holders. So it will be at least the cost of debt, if not more, and the cost of debt itself is very high. In that scenario, it will be, unless you can calculate a cost of equity through the CAPM model, you can take the cost of equity as the cost of debt.
Okay, thank you so much. So we can move ahead with the session.
All right. So we covered the tweaks in the DCF model for distressed assets. We considered the tweaks in relative valuation and how distressed equity can be calculated as a call option. Lastly, we'll see what will be the effect of illiquidity. So illiquidity, very bluntly defined, is buyer's remorse. That you bought something and now you're trying to sell it off. What will be the cost of that? The least cost for any market will be the bid-ask spread. That asset is selling in the market for a particular value and it's available to be bought at a particular value, there will be a spread in those two numbers. That will be the bid-ask spread. That is the least cost of illiquidity. Apart from that, there will be transaction costs. So all of that combined will be the cost of illiquidity. What are the ways to adjust for that? The correct way and the common way to do it is you take the transaction cost per trade in liquidity as a systematic risk factor. Like we factored beta as a systematic risk factor, we take it against the variation in returns across the market and take it against our industry or our company. Similarly, liquidity can be modeled. You compare the returns with the liquidity of different companies in the market, and you generate a beta for liquidity. And then you multiply it by a liquidity risk premium. That is the beta for liquidity. That is the correlation of the liquidity of your company with the liquidity of the market, multiplied by the market returns minus the risk-free rate. That will be the liquidity risk premium. To factor in that less liquid stocks will have more risk because they cannot be sold back again to the market, or at least there is a cost of selling them back to the market. So that is a way you can do it. The most common way people do it for small companies is they apply a DLOM, discount for lack of marketability, and they would put in any discount rate of 5%, 10%, 20% in that cost of liquidity. So any distressed asset you would be dealing in, and this is not just corporates, this can be used for any class of asset. Since it's distressed, there might be an additional cost of liquidity you might get into. You can treat liquidity as an option, but try not to do it. The mathematics will become absurd. Again, as an option, it can be done. Like you can base it on two variables that if it cannot be sold, then you lose your investment. And if it can be sold, then you earn on that investment. But that gets a little complicated. Another thing is that illiquidity discounts should be larger for investors with a shorter time horizon. If you're willing to stay with the asset and hold on to the asset, there is a higher probability that it will become liquid at a certain point in time later, or rather you'll be able to shave off the asset slowly. So you're not really bothered by the cost of illiquidity. So depending on what kind of investor you're doing the valuation for, the illiquidity discount also changes. And we have a explanation on what kind of assets are more or less liquid. So let's say government bonds and highly rated corporate bonds are very liquid. And as we move to the stock market, there are degrees of liquidity. There are widely traded stocks which are very liquid, and there are very small free floating market cap stocks. Then there are infrequently traded stocks. That is, the stocks get traded less than 10% of their market cap in the entire year. Several companies in India like that. Then real estate is quite illiquid. If you're buying a private business, that is even more illiquid than real estate. But it gets even more illiquid if you're buying a small stake in a private business without control. So all that do factor in as a cost to the transaction. And that needs to be again factored into the model. Best way to do it is you take the transaction cost and the number of trades per year to arrive at the illiquidity discount. I am done from my side. If there are any questions, we can take them.
Yes, sir, there are. Just give me a second. Okay. So in case a company goes in for restructuring, how is this factored in the valuation?
You asked that, na? Unless
Yes. I'm so sorry.
that's okay. Should I rephrase the answer?
No. I accidentally saw the same message again.
All right.
Okay, so the next question is, when valuing distressed firms, what consideration should be taken into account regarding the estimation of the year of distress and its impact on subsequent years?
So the correct way of doing it would be this small table over here. We will get into the maths of that. So let's say you arrive at the annual probability of failure using a credit rating of 20%. That in any particular year, the probability of failure is 20%. So the probability of survival becomes 80%. The probability of survival continuously for 10 years will be 11%. That is 80 multiplied by your projection period, 10. So the probability of failure in any one of those 10 years is 89%. So you take the value of the company as the value of a healthy company without any stress and multiply it by the probability of failure in any one of those 10 years, and you get the value of the distressed company that has been accounted for every that has been accounted that the company will remain a going concern for all those projection period.
So moving forward, the next question. In the context of distressed assets, why might incorporating the probability of distress into cash flow be mathematically challenging? And how would you navigate this challenge?
So the why it would be challenging is you do not know which assets you will. First thing is you do not know which assets you would be left with. So you do not know which assets, from which assets the cash flow you're supposed to take and not take. The way to account for that is you take all the cash flow from all the assets, you do not take any divestments, and you assign a probability that this asset might not be there with me for the entire cash flow period. You take a 20% to 50% discount and you reduce your entire cash flow by that value. So in that way, you will know that in that way you have accounted for the stress in the cash flows, but then you cannot incorporate the stress in the discount factor. You can incorporate it only in the cash flows or in the discount factor, not both.
Thank you so much. So there's a question with respect to slide 10. Variance in firm value. Why are we not taking stock price or bond prices?
The stock price or bond prices for this particular company might not reflect the true variance in the market because there might not be sufficient liquidity for this particular company to see that kind of variance. In distressed companies, you might not see too much movement in the stock prices or bond prices because no one's willing to buy or sell them. An industry average variance would be much more appropriate simply because of the liquidity issue.
So there's a question from slide 12. Private business with without control. What does control here means? Operational efficiency.
Not efficiency, but control, decision making. Let's say there's a private business and you own 51% or 75% of that business. So you gain more control over the management, you get to appoint the management, and you would want your nominees to be the director on the board of the company. Rather than that, let's say you own 20% or 10% in a private business, you don't really get any say in how the business is being managed or is being run. So there's a greater propensity to own businesses where you can control, and hence there's a lower liquidity discount on them.
So there's a follow-up question with the value we calculated, 2877. I'm not sure which slide it was. So the question is, it was discussed that adjustment needs to be made to calculate terminal value since perpetual growth may not be applicable to distressed firms. So in calculating the amount of 2877, how was the same factored in?
This was not factored in. Let me just show you this column so you'll understand this. We did this entire calculation assuming that the company will remain as a going concern. You will not be able to incorporate a not going concern value in the DCF. DCF is modeled based on a going concern. If you remove the going concern assumption, DCF fails because terminal value, what does it say? Terminal value says that this company will continue to grow on at 2% in perpetuity and its cost of capital will remain 8 in perpetuity. As soon as you remove these assumptions, you will not be able to calculate the terminal value. So the value of 2877 considers that the company is a going concern. Having said that, we calculate the probability of survival of the company and multiply the value of the firm with that to get a value of the distressed company. Now, what is the value of the company as a going concern? It is equal to the value of the projection period plus the terminal value, plus the present value of the terminal value. 2877 is the value, is the terminal value in the 10th year. The present value plus the present value of the projection period multiplied by the probability of survival for 10 years will be the true value of the company. 2877 itself will be a going concern value. There's no way you can calculate the terminal value not as a going concern. That will not be possible. It will have to be adjusted at a later stage.
We can move forward with the session.
That's actually all from my side. If
Okay,
there
so
are
I
no other
can,
questions,
yes, there are a lot of questions.
all right.
Okay, so
We can
I'll
take
just.
those up.
So the next question is, discuss the practical challenges in adjusting cash flows and discount rates for the likelihood of distress, especially when faced with uncertainties like political events or economic changes.
So there is no way in which you can have any unsystematic risk in a DCF model. If there is any political change or any untoward event happens, or even a breakdown of systems happen, let's say there is a fire in the factory, that cannot be incorporated in a DCF model. DCF will only incorporate systematic risks. Having said that, when there is a existence of distress in a company, then that can be factored in at either as reduced cash flows, and we take a probability that this particular asset will be sold off, hence its cash flows will not be available, or we tweak the discount rate to adjust for the cash flows as we had done, or we calculate the probability of distress and add. So we do a fair valuation of the company as a regular DCF model, and then we take a weighted average and we calculate the value of the firm in distress, and we take a weighted average with the probability of distress. So I think this is best explained over here, that the actual value of equity will be the DCF value multiplied by 1 minus probability of distress plus the distress value multiplied by probability of distress. This gives you the weighted average of equity.
So can you actually re-explain the reinvestment calculation? There are a lot of questions with respect to this particular slide, slide 5, asking for a reinvestment calculation to be explained again.
So, I do not have the assumption sheet with me here, but try to understand this. The company in year 3 makes this revenue, on which there's a EBIT margin of 2.8%, and this is the EBIT number. Now, this is a company in distress. Normally, after you reach the post-tax operating margin of a company, what do? You reduce the capital expenditure and working capital from the company. However, in this case, you are reducing assets from the company. So on a net basis, your capex will be negative, your assets will go down, and the reinvestment will be negative. That you're not earning from the money, earning from the company and investing in assets. You're divesting the assets and putting it into the company. So the reinvestment is negative. Now, for a typical normal company, it will be positive. And the FCFF, which is equal to the operating margin minus reinvestment, will be lower than the operating margin. For a distressed company, it is higher than the operating margin because the reinvestment is negative, because you're selling off assets.
Okay, so there's also a follow-up question with the respect to slide 10. How to calculate probability of survival?
See, let's say on an annual basis, probability of failure is 20%. So on an annual basis, the probability of survival is what? 80%. For 10 years, if the firm is to continuously survive, it will be 80 multiplied by 80 multiplied by 80 10 times. That is 80% to the power period. That comes out to be 11%. So the probability of survival for 10 years is 11%. The probability of failure in any one of the 10 years is 89%. And you multiply the value of the company as a going concern multiplied by the probability of failure in any one of those years, and that gives you the value of the distressed entity.
Thank you. There's another question. AS28 gives to reduce the value of those assets are not generating nor are used for the purpose are installed. It is not enough. Kindly elaborate.
I did not understand the question. Could you rephrase?
Yeah, just a second. Maybe I'll need slide reference for that. So I'll move forward with the next question. If negative cash flows are there in past and future projections are dependent on infusion of capital, shouldn't the valuation be under NAV?
NAV will anyway take, NAV has nothing to do with any future projections. NAV only incorporates what your company has as of date and tabulates the fair value of that. It has anyway, NAV has nothing to do with future projections. So how are those related?
Should I repeat the question?
Yeah, please.
The question says, if negative cash flows are there in past and future projections are if there are negative cash flows in the past and future projections are dependent on infusion of capital, shouldn't the valuation be under NAV?
NAV takes neither the consideration of cash flows nor does it take any future information into account. It will simply take what are the assets and liabilities as on date. It will not even go into what are the cash flows they're generating. It will simply go into what is the fair value of the assets as on date and add and subtract them to give you the equity value. That is what NAV does. So when we are talking about NAV, there's no point of talking about any future infusion or any negative cash flow in the past.
Explain bond price and its relevance.
Bond price and its relevance. So bond price is a way you can use to calculate the probability of distress. If this equation makes sense to you, this is what is the bond price that is trading in the market? It is equal to the face value of the bond discounted for whenever it will be paid back to you. That is the time period N. Plus all the coupons that will be paid to you whenever they will be paid to you. And these prices are available in the market. The coupon rate is available, the face value is available, the bond price is available, the tenure is available, the risk-free rate is available. The only factor in this equation that you do not know is the probability of distress. So if a bond price is quoted in the market, you can easily calculate the probability of distress for a particular bond. Now, why am I taking the risk-free rate and not the yield to maturity? Because the probability of default is already getting incorporated in that probability of distress number. So once that has been incorporated, there's no risk left in the bond, and hence we're taking the risk-free rate.
Moving forward to the next question. How do we determine the number of years for which projections needs to be prepared?
As long as it takes for you to bring the company to a healthy and stable state. You can only have a terminal value once the DCF has reached stability, that this is where we are and the cash and the margins are not going to be changing from here. So this is the growth we have achieved, that we are going to achieve till perpetuity. This is the cost of capital that we have achieved, that we are going to have till perpetuity. That's not going to happen in a single year. It's going to take time. As long as it takes to reach that stable stage where no growth or margin or cost assumptions are going to change, that will be your projection period. The terminal value can only be determined after stability has been reached.
So the next question is, at what stage do we compare divested value and decide to divest the asset?
You take it does not matter. You try to eliminate this question entirely from your calculation. You assume that after divestiture, the present value of the cash flow from the asset that you have divested will be equal to the present value of the divestment. That is one way of doing it. Another way is you declare that I do not know when the divestment will happen, but it can happen at any time during these 10 years. So you reduce a cash flow from all those 10 years, let's say 20% or 30%, you reduce from the entire period, because you do not know when the divestiture will happen.
There's again a question from this slide 5. Do we need to make adjustment on account of current market value of land and building as well?
The land and building, if they're operational assets, then they are already getting used to generate the revenue and they're incorporated in the cost. If they are not operating assets, then they need to be reduced or added separately. DCF will incorporate revenues from all the operating assets. So there's a question of, do you consider your land and building as operating assets or not? Or are they spare assets or free assets? This typically, the confusion happens is where you have a large chunk of land and you're using half of it. So do you consider the value of the land or not, or do you consider half of it? That is a gray area. There's no right or wrong answer to it, but we should at least be aware of what the gray area is. Land building, as long as it is operational, it is already incorporated in the DCF. If it is entirely non-operational, it is not incorporated in the DCF and it has to be added separately.
So the next question is, how would you approach estimating the probability of distress in a distressed firm, and how could this be practically incorporated into the valuation process?
Probability of distress, there are many ways of doing that. We discussed that. You can use the Altman Z-score, you can calculate it using bond prices, using credit rating scores, you can use a probit regression. Those are the ways you can estimate the probability of distress. How do we incorporate it? We incorporate it right here when we calculate the annual probability of failure. And you go ahead from there, that this is the probability of failure. What will be the probability of failure during the entire projection period?
Moving forward with the next question. How does the use of levered beta instead of regression beta contribute to the valuation of distressed firms? And what implication does the changing DE ratio have on the valuation over multiple periods?
See, your beta, as you're aware, is dependent on the debt equity ratio. The moment you use a regression beta, first of all, regressions are for long periods of time, typically 3 years to 1 year period, whereas the negotiation for restructuring happens at a relatively short period of time, within 6 to 18 months. So that is the first problem. Secondly, a regression beta will lead you only with one value of beta, whereas given that your debt equity ratio is changing, the beta also needs to change with that. Since the beta needs to change with that, it is better to leave away the regression beta, start with the unlevered beta, and then apply the debt equity ratio on it to get the levered beta and make your calculations on that. The short answer would be that since the debt equity ratio is changing, the beta should also change. Regression will not allow you to do that.
Moving forward with the next question. When incorporating a risk factor into the DCF model for distressed firm, what specific elements should be included to capture the complexity of distress, startup failure, or other unforeseen events?
Again, risk factors will only incorporate systematic risks. For any unforeseen events, it is much better to use a probability factor that you complete the entire calculation assuming that it is going to be a going concern, and you take the cost of debt and you take the existing cost of equity from KPIM and you estimate the cost and you estimate the discount factor as you normally do, and you multiply it with the probability of survival. The right place to tweak the DCF is not the discount rate, but the probability of survival.
Moving forward with the next question. Explore the difficulties and consideration involved in adjusting cash flow for distress, especially when variation in the growth rate may not necessarily even out over time.
Good question. So the DCF implicitly assumes that the variations in growth rate will even out. Unless you're incorporating that, the mathematics will not work out. You will not be able to project the revenues. So cash flows will be difficult to estimate. You can only take a reasonable estimate. After all, this kind of uncertainty is what the discount rate is built for. That this is what I'm assuming my cash flow could be. It may not be that. The discount rate is there to even out the uncertainty in the cash flows. It is not there to iron out the unforeseen events.
Discuss the significance of government guarantees and easy access to capital markets in determining the appropriateness of using DCF for distressed assets.
So DCF works under the assumption that you will be able to access capital at the appropriate risk rate. So let's say you're a very risky company. So you can simply in your Excel sheet model that, okay, I will pay a very high cost of capital and I will get that capital. That is easy to do in Excel sheet than to do in real life. Unless you're actually going to be able to get that capital at that discount rate, your DCF is going to be meaningless. So you have to keep your DCF in line with real world events. Let's say there's a very risky company and it says, okay, I'm very risky. I will give you an annualized return of 60%. That's not reasonable. Even though it looks good on paper, it's not reasonable and you're not going to be able to raise funds at that rate. So that is what we mean by unrestricted access to capital. That even though your Excel sheet might say that, okay, you keep the discount rate very high, but you raise capital, otherwise the firm will not survive. Maybe the firm will actually not survive. Secondly, DCF assumes perpetuity. The bulk of value of DCF comes from the terminal value. Terminal value comes only under the assumption of perpetuity. So the only way DCF works in its element without the assumption of bankruptcy is when we say that there is no probability of default or distress in the company. How does that happen? How do we say that this company will never default? When the company, even if it defaults, there is some other way in which its loan is guaranteed, either by a government guarantee, or it is such a large systematically important entity that the entity is bailed out or the banks are bailed out, but nothing happens to the operations of the entity. In that case, DCF works. Otherwise, you have to factor in for the distress.
So this was the last question that I asked, and thank you so much for such an insightful session. It was a great learning experience. So, dear participants, as we conclude this session, we extend a sincere thanks to our distinguished speaker, Vishal Gupta ji, for his valuable insights. We also express our gratitude to our chairman, CA Hansraj Chugh ji, and vice chairperson, CA Preeti Paras Savla ma'am, and the entire support team of ICAI for initiating and supporting this platform for the field of valuation and guiding us. Last but not the least, we also acknowledge and appreciate our audience for taking out time and dedicating your valuable time for your active participation. Thank you so much and have a wonderful day ahead. Thank you.
Thank you.